For years, the global financial system rested on a simple assumption. No matter what happens, U.S. debt will always find a buyer. Wars, recessions, inflation, none of it broke that belief. But recently, something changed. Not in a press conference, not in a political speech, and not with a market crash. It changed quietly, inside Treasury reports that most people never read. China, once the largest foreign holder of U.S. government debt, has been reducing its exposure. Not dramatically, not suddenly, but consistently. This wasn't an emotional decision, it wasn't retaliation, and it wasn't accidental. It was strategic. U.S. Treasuries are not just bonds. They are the foundation of the dollar's global dominance. They finance America's deficits, its military reach, and its economic stability. When a major holder steps back, the system doesn't collapse immediately. Instead, stress begins to accumulate. Interest rates feel pressure. The Federal Reserve absorbs more risk. And confidence, the most fragile asset of all, starts to thin. The danger here isn't what people can see. It's what they assume doesn't matter. Because every major financial crisis in history began the same way, with one player deciding the risk was no longer worth it. Let's clarify something important. China did not wipe out U.S. debt, and it did not dump all holdings overnight. That kind of move would be reckless, and China is not reckless with reserves. What happened instead is far more serious. China has been systematically reducing dependency on U.S. Treasuries while increasing diversification into other assets, currencies, and bilateral trade systems. This signals a shift in trust. U.S. debt only functions smoothly when demand is global and unquestioned. When large holders quietly exit, the burden doesn't disappear, it shifts. The Federal Reserve steps in more aggressively. Domestic buyers absorb more issuance, and the system becomes increasingly self-referential. That's when debt stops being global and starts becoming fragile. This isn't about one country. It's about precedent. If China sees long-term risk in holding treasuries, others will analyze the same data. And they already are. Debt doesn't collapse because someone sells. It collapses when confidence stops renewing itself. And confidence, once questioned, does not return easily. For decades, the U.S. dollar wasn't just a currency. It was a tool of power. Trade settlements, energy pricing, sanctions enforcement, global banking access. Control of the dollar meant control of the system. But power always creates incentives to escape it. Over the last several years, the U.S. increasingly used the dollar-based financial system as a geopolitical weapon. Countries were cut off from payment rails, reserves were frozen, access was restricted. From Washington's perspective, this was leverage. From the rest of the world's perspective, it was a warning. If reserves can be frozen, if transactions can be blocked, then holding too much exposure becomes a risk. China understood this early, not emotionally, not ideologically, structurally. Reducing U.S. Treasury exposure wasn't about hurting America. It was about reducing vulnerability. Because when money becomes a weapon, neutral assets no longer feel neutral. This is how trust erodes in systems that depend on trust to function. No announcement is made. No red line is crossed. Participants simply start preparing for a future where dependence is dangerous. And once preparation begins, reversal becomes unlikely. China's shift isn't happening in isolation. It's happening alongside a broader reconfiguration of global finance. Bilateral trade agreements settled outside the dollar. Currency swaps that bypass traditional clearing systems. Reserve diversification into gold and non-dollar assets. These moves are not about replacing the dollar overnight. That's impossible. They're about reducing reliance over time. This is how systems change in the real world. Not through collapse, but through redundancy. The dollar doesn't fail because someone attacks it. It weakens when it becomes less necessary. Every trade settled without dollars is a small subtraction. Every reserve diversified is a small insurance policy. Individually, these actions seem harmless. Collectively, they alter the foundation. The danger isn't that demand disappears suddenly. The danger is that it stops growing. A system built on continuous expansion cannot tolerate stagnation indefinitely. And when debt levels are already historically high, even small shifts in demand have outsized consequences. Global reserve currencies don't collapse suddenly. They decay. The British pound didn't lose dominance in a single year. It weakened slowly after World War I as debt accumulated and global trade patterns shifted. For decades, the pound still existed. It was still used, but it was no longer unquestioned. The transition wasn't announced. It was experienced. The same pattern appears again and again in monetary history. A dominant power finances wars and expansion with debt. Foreign holders accumulate that debt because the system feels stable. Eventually, returns stop justifying the risk. That's when diversification begins, not as protest, as protection. What makes the current moment unusual is scale. U.S. debt levels are historically high. Deficits are structural, not cyclical. And foreign participation is no longer growing the way it once did. This doesn't mean collapse tomorrow. It means the margin for error is shrinking. Systems under strain don't break when pressure increases. They break when flexibility disappears. And flexibility is what excessive debt removes first. When foreign demand weakens, the question becomes unavoidable: who absorbs the supply? Increasingly, the answer is domestic institutions and the Federal Reserve. This creates a closed loop. Debt issuance rises. Demand becomes less external. Intervention becomes more frequent. Over time, markets stop being price signals and start being managed outcomes. That management works until it doesn't. The more the system relies on internal support, the more fragile confidence becomes. Because confidence doesn't come from control. It comes from participation. Foreign buyers provide validation. They confirm that risk is being shared. When that validation fades, the system depends on credibility alone. And credibility is difficult to maintain when debt expands faster than economic growth. Most financial breakdowns are not caused by bad intentions. They're caused by bad timing. High debt can exist for years without consequence, as long as growth, confidence, and liquidity remain aligned. The problem begins when multiple pressures converge: slower global growth, rising interest costs, geopolitical fragmentation, and declining foreign appetite for debt. None of these factors alone is fatal. Together, they reduce tolerance for shock. This is why gradual moves like reserve diversification matter more during periods of tightening financial conditions. China's actions are not destabilizing by themselves. They become significant because they're happening in a world with less margin. Debt refinancing becomes more sensitive to rates. Policy responses become more constrained. Interventions become more frequent and less effective. At this stage, stability depends on expectations holding, not improving, just holding. And history shows that when expectations stagnate long enough, they eventually adjust. In debt-heavy systems, failure rarely appears where people are looking. It doesn't begin with a currency collapse. It doesn't start with a default. It begins with friction. Market liquidity thins. Volatility spikes unexpectedly. Interventions become routine instead of exceptional. Confidence erodes not because something fails, but because nothing improves. This is the phase where narratives change. From temporary to structural to normal. Once instability becomes normalized, risk is mispriced. And mispriced risk is how systems lose control quietly. The most dangerous moments are not crises. They are calm periods where stress is absorbed, postponed, and layered. Because layered stress eventually demands release. And when it does, it rarely follows predictions. Most financial systems don't fail because of a single decision. They fail because pressures accumulate quietly over time. High debt is manageable when conditions are forgiving. It becomes dangerous when conditions tighten. Rising interest costs increase the burden of refinancing. Slower growth reduces the ability to absorb that burden. And geopolitical uncertainty limits cooperation when coordination is most needed. In this environment, even small shifts in behavior matter. Reserve diversification is not an act of aggression. It is an act of risk management. Countries do not move away from dominant systems because they want change. They do so because they no longer trust stability to be permanent. This is why timing matters more than intent. China's gradual reduction in U.S. debt holdings is not destabilizing in isolation. It becomes significant because it aligns with broader structural pressures already present in the system. When margins shrink, tolerance for surprise disappears. At that point, systems stop absorbing shocks smoothly. They transmit them. What once felt distant becomes connected, and what once seemed manageable becomes sensitive to disruption. This is how stable systems move closer to fragility without appearing broken. In periods like this, markets do not signal danger with dramatic events. They signal it through behavior. Liquidity becomes selective. Volatility appears without clear cause. Policy interventions become frequent enough that they stop feeling temporary. These are not signs of collapse. They are signs of strain. Strain accumulates when systems are pushed beyond design limits. The U.S. debt market was built on the assumption of endless global demand. When that demand becomes conditional, the structure must compensate internally. That compensation works, but at a cost. Intervention replaces participation. Management replaces price discovery. Over time, this reduces resilience. Because resilience depends on diversity of buyers, not concentration of support. When fewer participants are willing to absorb risk, the system becomes more sensitive to timing errors. Small policy miscalculations have larger effects. External shocks travel faster, and recovery becomes harder to sustain. This is the stage where confidence still exists, but no longer expands. And when confidence stops expanding, systems begin relying on belief rather than validation. Most financial breakdowns are misunderstood because people look for intent instead of structure. Systems rarely fail because someone wants them to fail. They fail because the structure can no longer support the weight placed on it. When debt expands faster than productive capacity, flexibility erodes, policy options narrow, reactions become predictable. At that point, stability depends less on strength and more on coordination. But coordination is hardest when trust is lowest. This is why transitions in global finance are slow at first and sudden later. Adjustments happen quietly until a threshold is crossed. Then, markets reprice faster than narratives can keep up. This does not require panic. It only requires realization. Once participants recognize that assumptions are no longer reliable, behavior changes. And when behavior changes at scale, systems adapt whether policymakers are ready or not. This is the phase where history stops being theoretical. Not because collapse is guaranteed, but because outcomes become asymmetric. Risks grow faster than protections, and timing becomes the dominant variable. What usually breaks first in debt-heavy systems is not the headline asset. It is the surrounding mechanisms. Liquidity support becomes routine. Market signals lose clarity. Intervention becomes expected rather than exceptional. This shifts behavior. Participants stop positioning for growth and start positioning for protection. When that happens, capital becomes defensive. Defensive capital does not disappear, but it moves differently. It seeks stability over return. It prioritizes optionality over commitment. This changes how systems respond to stress. Recovery slows, volatility becomes persistent, and policy tools lose effectiveness because expectations have changed. At this stage, narratives often lag reality. Officials speak in reassurances. Markets respond with hesitation. This gap between words and behavior is where instability grows, not explosively, but incrementally. Each adjustment appears rational on its own. Together, they transform the system. By the time consequences become visible, the transition is already advanced. China reducing U.S. debt holdings is not a headline event. It is a signal, not of collapse, not of confrontation, but of recalibration. Global finance does not change through announcements. It changes through behavior. Trust does not disappear. It redistributes. The dollar does not lose relevance because someone declares its end. It weakens when alternatives quietly become functional. What matters here is not the size of China's actions, but the direction. In systems built on confidence, direction matters more than speed. Debt sustainability depends on renewal, the continuous willingness of others to participate. When participation becomes cautious, systems adapt. When it becomes selective, systems strain. None of this guarantees crisis, but it guarantees change. And change always favors those who recognize signals early rather than those who react late. History shows that financial dominance ends not with chaos, but with adjustment, slow enough to ignore, clear enough to recognize if attention is paid. The question is no longer whether the system will look different in the future. It is whether the transition remains orderly, and that depends on how many warning signs are dismissed as insignificant before they become impossible to ignore.